Namaste to all. Here I am with a new video relating to capital gain on transfer of equity shares or equity oriented units or equity oriented fund. I am expecting a question this time from this topic. So I hope, because there are some amendments in this section, so I am expecting a question from this topic. And students generally have a confusion in this topic, not chapter. So equity shares are equity oriented units or fund, equity oriented fund. If it is unlisted securities, we need to check what period of holding. If period of holding in case of unlisted securities or shares, period of holding greater than or more than 12 months, then it will be taxed as long term capital gain under section 112 at the rate 20%. Simple. Unlisted, check the period of holding. If it is more than 12 months, long term capital gain under section 112, tax at 20%. That's it. If it is less than 24 months or equal to 24 months, so period of holding less than or equal to 24 months, we need to take it as short term capital gain, and normal income, it will be treated as normal income. On normal income, tax will be calculated at slab rate. On normal income, tax will be calculated at the rate slab rate. Generally, capital gain means you people assume that 20% or 50%. In case of normal, to follow slab rate of tax. Which rate of tax we need to follow? We need to follow slab rate of tax. Tax at slab rates. That's it. Purposefully, I didn't make any thing at here for normal income. People will forget about this point. That is why I made it as I need to write while explaining. So I didn't make any circle or any other thing for this point. So now I will make a circle for this. Okay. So tax at slab rate for normal income. Okay, till here no problem, I think. Let us do the, if it is unlisted, depending upon the POHA, POHA means period of holding of asset. Greater than 12 months, less than 12 months. Greater than 12 months, tax at 20%, less than 12 months, short term capital gain, normal income, slab rate tax. That's it. So when you treat it as unlisted. When you treat it as unlisted, if shares are in unrecognized stock exchange, sold in unrecognized stock exchange, are sold privately, they will tell in the question. So please remember that point. If shares are listed in stock exchange, if shares are listed in stock exchange, how to deal that point? So let us see. If shares are listed in stock exchange, period of holding less than or equal to 12 months. If it is less than or equal to 12 months, shares are listed in stock exchange and period of holding less than 12 months. If STT is not paid, if STT not paid, on which STT is not paid will be considered as short term capital gain, normal income. Listed in stock exchange, period of holding less than 12 months. If STT paid, then will be considered as short term capital gain under section 112A, tax rate at the rate 15% we need to take. I repeat again, if it is listed in stock exchange and period of holding less than 12 months, please remember here 12 months, okay, and STT is not paid, short term capital gain, normal income means tax at slab rate, we need to take, okay, and if it is STT paid, if it is STT paid, then it will be taxable as per short term capital gain under section 112A at the rate 15%, okay. These are special incomes, okay. Next point, if it is listed equity shares or units and period of holding is greater than or more than 12 months, and if STT is not paid, okay, if STT is not paid, we will consider it as long term capital gain and it is taxable under section 112 at the rate 20%, This is what about listed equity shares or units, period of holding more than 12 months and STT is not paid. Next, so listed in listed in stock exchange or sold in recognized stock exchange, they will tell holding more than 12 months and STT paid. This point we are discussing. This is the new thing, new amendment for you all. We have discussed in the class also. So let us do this. STT paid. STT is been paid. It will be treated as long term capital gain under section 112A. 112A amended new one. So आएगा एग्जाम में, so please be careful. It is taxable at the rate 10% above 1 lakh. Above 1 lakh is taxable, not entire amount. So period of holding, if please remember, if STT is not paid, long term capital gain under section 112 and taxable at the rate 20%. If STT is paid, then it will be taxable as here in the given case, STT paid long term capital gain under section 112A, tax at the rate 10% above 1 lakh. Please remember this point. And in case of equity share, STT should be paid at the time of purchase as well as sale. And in case of units or equity oriented fund, STT should be paid only once at the time of sale. That please remember that point. So the same thing is been written here, and how to compute under section 112 and 112A, that is we are going to discuss now. Under section 112 and under section 112A, how to calculate tax, that we are going to discuss now. So till here we have seen how to compute tax under section 112A and 112. We are going to see under section 112A, under section 112A, on transfer of listed securities in a recognized stock exchange and STT paid. In case of shares on both sale and purchase, STT should be paid. In case of units or fund on sale, it should be paid. Capital gain will be computed without indexation benefit. Without indexation benefit, and tax is paid at the rate 10%. Percentage symbol is missing. Above 1 lakh, tax is paid at the rate 10%. There is some little bit problem in the app. If my sound and the video if not matching, please adjust with it. I am trying to match the both things. So I'll tell you again. Under section 112A, on transfer of listed securities in a recognized stock exchange and STT paid. Please remember, all these things should be done. In case of shares on both sale and purchase for the units on sale, STT should be paid in case of shares at the time of both sale and purchase, and in case of units at the time of sale. Capital gain computed without indexation, and tax is paid at the rate 10% above 1 lakh rupees. Up to 1 lakh rupees, it is not taxable. Similarly, in case of under section 112, okay, under section 112 long term capital gain only. In case of long term capital gain on securities, assessee will be given choice to pay tax of two options, in which tax liability will be least. We wrote 20% now, but in case of equity shares, assessee will be given an option to pay tax in which he is getting lesser tax. So option 1, with indexation benefit. In this, indexed cost of acquisition will be done and tax is paid at the rate 20% flat rate. Option 2, without indexation benefit, tax at the rate 10% we need to calculate. So there are two options for 112, and in case of 112A, tax will be calculated directly at the rate 10% on above 1 lakh. Please remember these 2 points. So let us do one problem relating to this concept now, so that you can remember the entire thing. Before doing the problem, let me tell you one thing related to provisions relating to 112A, computation format relating to 112A. Long-term capital gain under section 112A, particulars, rupees, full value of consideration less transfer expenses, then you will get net consideration, and less cost of acquisition. Here in case of 112A, we will take cost of acquisition, not indexed cost of acquisition. Then you will get long-term capital gain before exemptions and other things. So this is the format. How to get cost of acquisition? Actually, I have made one video relating to all the provisions. Before doing any problem, first go through the provisions, then do the problem. Okay, so that you can easily solve the problem. So cost of acquisition, how to get cost of acquisition? Cost of acquisition will be higher of the following: A, actual cost of acquisition, or B, least of following. 1, fair market value on 31/1/2018. Please remember, in case of 112A, cost of acquisition is very important point. So fair market value on 31/1/2018, 31st January 2018 we need to take, or sale consideration, whichever is least, and A or B, whichever is higher. Here arrow marks also given in your notes also, so please consider this point. So let us see the solution relating to question relating to it and answer relating to that question. Question number 16 we are going to do now. So 15 also related to same concept, and 17 also related to this itself. 18th 19th also related to shares related questions itself. You people do rest of the problems. Now I am explaining question number 16. On 15/6/2002, Mr. B.R. Vijay purchased 600 listed equity shares. Which shares? Listed equity shares in a limited company in a Bombay Stock Exchange at 250 each. Cost of inflation index is 105 for 2002 and 3 they are saying. Calculate tax liability listed in each of the following situation if income from other heads is 2,70,000. We need to calculate the tax liability in case of two situations. Situation 1, if shares are sold on 11/7/2018 at 720 rupees per share. This is the sale value. Full value of consideration we will consider. At 720 per share into 600 we need to take. In a recognized stock exchange, if you are selling in recognized stock exchange, it means that you are paying STT, and it is purchased also from Bombay Stock Exchange, which is the recognized stock exchange. If at the time of sale and purchase STT is paid, so it is taxable in this situation 1 as 112A under section 112A. And fair market value on 31/1/2018 is 600. So sale value or this value are 250. Which one is we need to take as cost of acquisition? That we will see in the problem. Later on we will do the situation 2. In situation 2, if shares are sold on 11/7/2018 at 720 per share in unrecognized stock exchange are sold privately. In case if shares are sold in unrecognized stock exchange are sold privately, then we need to do as per section 112. As per section under section 112 we need to calculate long term capital gain only. Long term capital gain only will be calculated because these are listed shares. If period of holding POHA greater than 12 months will be long term. Here he has purchased in 2002 and selling in 2018, both the cases. So period of holding is more than 12 months. So those are long term itself. But under section which it is taxable, long term capital gain under section 112 it will be taxable in situation 1. In situation 2 it is sold in unrecognized stock exchange or sold privately, then we need to calculate under section 112. Here assessee will get two options. Option 1 with indexation, with indexation 20% tax. Option 2 without indexation, without indexation tax at the rate 10%. Let us solve the problem now. So we are doing question number 16. Question number 16 we are doing under situation 1, sold in recognized stock exchange, computation of income from long term capital gain under section 112A. BR Vijay for the assessment year 1920, particulars rupees. First full value of consideration 600 equity shares into 720, it has become 4,32,000. Less transfer expenses not given here. STT paid will not be considered as transfer expenses. Less transfer expenses, you will get net consideration as 4,32,000 itself. Next, cost of acquisition we need to see. How to get cost of acquisition? Cost of acquisition we have to see in the working note. Let us go to the working note. Relating to this problem. Where is the working note? Here is the working note. Cost of acquisition, higher of the following: actual cost, that is 600 shares into 250 rupees each. Okay, 1,50,000. B. List of the following two. Fair market value on 31st January 2018, that is 600 shares into 600, 3,60,000, or actual sale consideration, that is 4,32,000. Whichever is lower will be taken first from B point. Fair market value or sale value, which one is lower? 3,60,000 is lower value, that is taken outer side. Then higher of the following means A or B, whichever is higher, that is 1,50,000 or 3,60,000. Which one is higher? 3,60,000 is higher. That will be taken as cost of acquisition. This 3,60,000 we will take here for computation purpose also. So from working note 1, we have got from 4,32,000 we need to deduct. From 4,32,000 we need to deduct 3,60,000. 72,000 is the long term capital gain, and up to 1 lakh rupees it is not taxable. Up to 1 lakh rupees it is not taxable. Here 72,000 means nothing is taxable, it is exempt. So remaining amount only will be taxable in this case. Remaining amount only will be taxable. So 72,000 is not taxable. So nil. In situation 1 it is not taxable. So tax liability also he has asked. In situation 1, let us see the tax liability. In situation 1, tax liability will be as follows. Tax on total income of 2,70,000. Other heads is there. Up to 2,50,000 nil. 2,50,000 to 2,70,000 5%, that is 1,000 rupees. Tax at slab rate before rebate is 1,000 rupees. Rebate under section 87A, whichever is less. A. Tax amount are 2,500. What is tax amount? 1,000 rupees is the tax amount. 2,500 is the rebate. Which one is less? Tax amount is less. So 1,000 rupees will be allowed as rebate. So total tax liability will become nil in situation 1. I repeat, in 112A you are getting 72,000, which is less than 1 lakh. What we said under section 112A, above 1 lakh rupees only taxable. Long term capital gain above 1 lakh is taxable. It is 72,000, so not taxed. Other, if it is more than that, then it will be taxable. That we will see. Okay, up to 1 lakh rupees it is not taxable. That is what here means. So other income is there, that is normal income, that is taxable at the rate slab rate, so that is been taxed. Next situation 2. In situation 2 what happened? In situation 2 they said if shares are sold in unrecognized stock exchange or sold privately, assessee will be given a choice to pay tax from the following two options in which his tax liability will be least. Under section 112 you will pay under section 112, but out of two options whichever is more beneficial, in which tax liability is less, that will be taken. So let us see that here. Option 1, long term capital gain with with indexation taxable at the rate 20%. Option 2, long term capital gain without indexation benefit tax at 10%. So two situation 2 option 1. Situation 2 option 1, computation of income from long term capital gain of B.R. Vijay for the assessment year 1920, particulars rupees. Full value of consideration similar to earlier, 600 into 720, 4,32,000. Less transfer expenses nil, net consideration 4,32,000. Less indexed cost of acquisition, okay, purchased after 1/4/2001, that is cost of acquisition into CI of transfer year divided by CI of purchase year. So let us take the value now. 600 into 250 into 280 divided by CI of purchase year 2002 is given in the question 105. If you do, you will get 4 lakh rupees as indexed cost of acquisition that is being taken here from 4,32,000. If you deduct 4 lakhs, then it will be 32,000. If 32,000 is taxed at the rate 20%, 6,400 is the tax. Let us see in situation 2 how much tax we are going to, in option 2 how much tax we are going to get. So let us see the option 2. In option 2, situation 2, computation of long term capital gain without indexation benefit at the rate 10%. So particulars amount, full value of consideration 4,32,000, less transfer expenses nil, net consideration 4,32,000, less cost of acquisition, that is 600 into 250, 1,50,000. Here you will get the amount as I think 72, wait a minute, from 4 lakh 32,000. If you deduct 1,50,000, it will be 2 lakh change, some amount will come. Let us see where she has did. Alright, here. So long term capital gain 2,82,000 at the rate 10% tax is 28,200. Which option tax is less? In option 2 you are getting 28,200. In option you are getting 6,400. Option 1. Option 1 is less. So while calculating tax liability, we will consider option 2. Option 1 instead of option 2. So computation of tax liability in situation 2, let us do. So computation, see, you can check the time now. It's 4:11 from morning 3:30. I am recording this video for you all so that I can prepare for my exams and you can prepare for your exams also. So otherwise I am not getting enough time to record the video. So I thought it would be better first I'll give a video for you all today so that you prepare, and meantime I'll also prepare. Okay, those things are apart from, leave those things. Let us do the problem. So computation of tax liability in situation 2, particulars. Tax on normal income, that is 2,70,000 at the slab rates, up to 2,50,000 not taxable, 2,50,000 to 2,70,000 on 20,000 rupees 5% it will be 1,000. And tax on special income long term capital gain at the rate 20% on 32,000. In option 1 we have taken 6,400. Tax before rebate is, total tax before rebate is 7,400 less rebate under section 87A, whichever is less. Tax amount, that is 7,400 or 2,500, which one is less? 2,500 will be less, so we will deduct 2,500 from this. So you will get tax before HEC 4,900 and HEC at the rate 4% 196. So if you add, tax liability will be 5,096. Don't leave the answer at here, because tax should be rounded off under section 288B nearest to rupees of 10. So 5,100 will be your last answer. So here ends the answer for question number 16. So if any point you don't understand, please, it is a recorded video, you can go back to the video and revise it again. Slowly you understand. So I am expecting a question from this topic itself this time. It is my expectation. Don't do only this problem, do this problem also. Okay, so this notes is given in the description link. In the description link you can get the links related to notes, so find the notes from there. And anything to say? Nothing, just prepare well for the exams. Don't think it is too cool and other things, because weather is doing its duty, you need to do your duty. Cover yourself with uh, anything and do the preparation. मैं तो बस बेडशीट पूरा ओढ़ लेके बैठ के अच्छी तरह प्रिपेयर हो जाता हूँ मेरे एग्जाम्स के लिए. So you need to do. Okay. That's it. सीखना बंद तो जीतना बंद. सीखते रहो जीतने के लिए. जय हिंद. You can find the questions and answers in the description link with the notes and other things. Jai Hind.